So basically, there's pools of dead capital out there, and the two big ones are the Treasury General Account and reverse repos. So the Treasury General Account is the Treasury issues bonds and collects taxes, and money goes into their. They basically have a checking account at the Fed. It's the Treasury General Account. It's their working capital, their cash balance, and then they're always spending on various the entirety of the government. Um, and so there's like that float that they have there at all time. And that's capital that, if they issue a ton of bonds or have a big tax season and they suck a lot of money in, but then they're slow to spend that back in, they basically have sucked more money out of the economy than they put back in.
Mm.
In today's deep dive into the world of finance with Lyn Alden, we uncovered critical insights into the intricate dance between liquidity, economic trends, and market dynamics. Alden expertly navigated through the surprising twists of fiscal policies and global liquidity, shedding light on the resilience of certain assets amid economic softness. From the divergence between liquidity-driven and economy-driven assets to the Treasury's strategic moves countering the Federal Reserve's tightening, we gained valuable perspectives on the forces shaping the financial landscape. Alden's analysis of interest rates and the impact on different segments, from small businesses to the federal government, provided a nuanced understanding of the complexities at play. As we reflect on today's discussion, it's crucial to stay informed and adaptable in the ever-evolving world of finance. With that, let's dive into the video to hear Lyn's full thesis.
And so while that capital's in there, it's dead capital. It's been removed from the system, but it hasn't been recirculated back into the system yet. And so the bigger that is, all else being equal, that is like it's the bigger that is, the more negative it is for liquidity, because that's removed capital. And the inverse is true. If they draw that down, it just shoves all that capital back in. They're spending money back into the economy that they're not taxing, and they're not raising bonds to pull in because they've already pulled that in. And so while that's being put in, it's pro liquidity. And normally they try to keep a pretty static balance, several $100 billion in that at all times. And of course, they've raised it as all the numbers get bigger. The deficits get bigger, the nominal GDP gets bigger, everything gets bigger. So their target gets bigger, but they try to have a pretty fine target. But what really kind of put that into overdrive was the debt ceiling. So
Mhm.
one of the things that they do in response to a debt ceiling, they're told by Congress, okay, you've hit the debt ceiling, you can't issue more bonds, but you still have your bills to pay. So imagine if you're a homeowner or any sort of household, and you've lost your income, but you still have your cash savings. You have no choice but to start spending your cash savings on your bills, and that's what the Treasury does. They just kept spending without raising more, and that while that happens, it pushes all that money into the economy. So that's number one, is just dead money coming back in. And
Got it.
two, the reverse repo is not identical to that, but it's similar. Basically, the back when the Fed was doing QE, they did so much so aggressively that they actually did even more than they needed to.
Mhm.
And so there was actually a lot of excess cash that would have preferred to be in T-bills, because it's safer than a bank. It's T-bills are you're backed up by the federal government rather than a private institution with a quarter million in FDIC insurance. And so T-bills are very desired. And what the Fed didn't want was all that extra capital pushing T-bill yields below their target rate. There'd be ironically excess demand for T-bills. They don't want that. So they said, okay, instead of pushing T-bills, everybody fighting over T-bills and kind of interfering with our ability to be hawkish, they opened this other facility and said, you can
Mhm.
put cash into here and you can actually borrow T-bills, and the rate is set slightly above their lower bound. And so it's kind of like this extra void of money that wants to be in T-bills, but can't be yet because it's not enough T-bills, and it doesn't really want to be in banks either. And so as the Treasury issued a ton of T-bills, they were able to soak up money from this facility and then spend it into the economy. Which
Mm.
again, this void is kind of like dead capital. It's just excess cash that just wants to be in T-bills. They actually put it into T-bills and then spend it back out. So again, they're able to they're raising income, but that income's not coming out of bank reserves. It's not coming out of household savings. It's coming out of reverse repos, which are already this void. So it actually brings it back into the system, which is pro liquidity. And so that's why the two phases. One was first with the TGA, and then the second was the reverse repo facility. And together they were enough to roughly offset the Federal
Mm.
Reserve's quantitative tightening. So bank reserves right now are higher than they were at the beginning of 2023, because these net effects have been slightly bigger than the Fed's tightening.
In this next discussion, Lyn Alden delves into the consequences of raising interest rates beyond 3%, a move that initially feels positive but carries significant implications for the fiscal deficit. Alden highlights the growing concern over the sustainability of the mounting debt and deficit situation, prompting a critical examination of the economic landscape. The macroeconomic shift, particularly the structural change in demographics with the baby boomers' retirement, emerges as a key factor driving the divergence between the deficit and the economy. As interest expenses escalate, compounded by demographic headwinds and changing dynamics in programs like Social Security, Alden underscores the pressing need for a nuanced approach to address these challenges.
Yeah, and part of why I was, not expecting them to be able to raise rates more than 3% is because the amount that blows out the fiscal deficit is kind of
Yeah.
unfathomable. And
Yeah.
yet they did it anyway. And the effects are, at first it feels good because deficits feel good on the economy while it's happening, but then more and more people are
Yeah.
kind of looking at this debt and deficit situation and realizing that it's increasingly kind of unsustainable.
Hmm.
And so that has been, kind of a huge factor. And
Yeah.
so one another thing is that one of the key things that got me into macro, I used to be more focused on equity investing. And back in 2016, 2017, I wanted to start focusing more on macro. And it was because we had an unusual divergence between the deficit and the economy. So if you look back in modern history, normally, the deficit's smaller during a strong economy, and it's weaker during a recession.
Hmm.
But we started to get this divergence in 2016, 2017, where the deficit was actually getting worse,
Hmm.
while the economy was still strengthening.
Yeah.
Um, and the reason was a couple reasons, but a key one was the baby boomers were kind of reaching their peak retirement years. And so
Mm.
the demographics of the nation were structurally changing for the worse deficit wise. And
Wow.
so that was a key variable that happened. Then it was amplified by the fact that we had tax cuts that were not funded
Hmm.
by spending cuts. And so that added to the deficit. Then of course COVID blew it out. And then even after that, now what we're getting is the interest expense is
Hmm.
blowing it out. In addition to that demographic headwind still being there. And so a stat that I point to is that, for decades, the Social Security fund was increasing. So more money was going into it than was coming out. But, starting a couple of years ago, that began rolling over. And it'll take a while to drain all up until kind of the mid 2030s. But basically, it's the whole demographic situation has shifted. And so that leads to these structurally higher deficits because these programs were not really balanced with that in mind when they were kind of originally set decades ago, and there's been not significant modification since then.
Thanks for diving deep into today's discussion on the intricacies of Treasury operations and their impact on liquidity. We've explored the crucial roles of the Treasury General Account and reverse repos, understanding how they influence the overall financial landscape. Remember, the ebb and flow of capital in these pools have significant implications for liquidity, making it a vital aspect of the economic puzzle. If you found this analysis insightful, don't forget to hit the like button, subscribe to our channel, and ring the notification bell. Your support keeps the conversation going. Share your thoughts and questions in the comment section below.